Hi, my name is Martin Warner. I work at Confio, and today I'd like to talk to you about regulated DeFi. Does this stifle innovation, or is it an opportunity? So what I'm going to do today is talk for 25 minutes and have 5 minutes for questions at the end. So keep your questions coming in, and I'll answer them all when I've done with the presentation. So first question, I guess, is what is DeFi? For those of you who don't know, short for decentralized finance. It's been a really hot topic in 2020 with the growth that we've seen in Ethereum. And the big thing about it, it's a form of finance that doesn't rely on central intermediaries, which is quite a big change from how things are done presently in traditional markets. So DeFi, why should we be excited about it? Why is it interesting? So I guess the first starting point and the really interesting thing from I guess a user experience is its simplicity. It's really, really cool that I can send funds to a smart contract and it does absolutely everything for me. So I can deposit an Ethereum into a smart contract and it goes through the process. It collateralizes my debt position, it issues me a DAI token, and I'm up and running and I can do things with that. So that in itself is something really important. The pace of innovation of DeFi is really high through the development of smart contracts. We're seeing the combination of finance and governance tokens on how these things work, and they're becoming very modular and building blocks, so we can reuse them to create new instruments or combine them with other ones. So in short, it's a really, really exciting area. So then we turn to regulations. So why regulations? What have they ever done for us? I should have the freedom to invest money where I like, when I like, and have that complete choice, right? Well, actually, no. And I'll challenge that, because having complete freedom of the ability to trade, to do what I like, means that we don't necessarily have fair markets, and the end investor, is not necessarily up to speed with what these instruments do. So if we look at a fair market, that means there's no wash trading going on. So a wash trade is basically trading with myself to make an exchange look really attractive, and then trending, I can buy and sell to myself to make it look like there's a lot of activity going on. Spoofing is when I show a price, people get excited, and then I pull the order just to get people to trade. And then we know about pump and dump, as you spread some rumors through Discord or Telegram, whatever your favorite channel is, to really talk up the price of something, and then you're dumping the stock as it starts going up, whatever token you're buying, and so on. So the point of fair markets, it really makes sure that we all have the same level playing field, that the sensitive information is released and available to everyone at the same time. So we don't have favored people getting information earlier, which means that they can benefit from that to the detriment of everyone else. And the investor protection is really, really important, because sometimes instruments can be complex. They can be hard to understand the risks of what you're trading. What is the downside? What could possibly happen? And in what circumstances? So we know that banks are very heavily regulated, and yet they still breach the rules. So imagine a world, what would happen if there were no rules in place at all? And to illustrate that, I guess you can look at the metrics that global banks have paid over 300 billion in fines just since the financial crisis for misbehaving. And the list's fairly long: money laundering, rigging of LIBOR, rigging the foreign exchange markets, and so on and so forth. So I think with regulations and protection, it's a fairer way to do finance. Then we look at the excitement in DeFi. It's in the low billions, and you can look at that in DeFi Pulse. It's a nice website that tells you what's going on, how much is locked in value, and so on. Then we look at the traditional markets. So a good reference source there, if you're curious, is the Bank of International Settlements publishes statistics for the different markets, traditional markets. So, debt, foreign exchange, derivatives, and so on. And there we're looking at thousands and thousands of billions. So the traditional markets are way, way bigger than the DeFi markets. And the barrier to DeFi is the regulated institutions really need to be able to demonstrate compliance to the rules of where they're actually registered. So in all the different countries around the world, so there's 200 different regulatory regimes. Each one of those institutions registered in those regulatory regimes need to be able to demonstrate that they really are behaving and following the rules properly. Now, in a completely free-for-all DeFi, the first stumbling block is you need to know who you're trading with. So are they within your market, as in the same jurisdiction as you, or is it somebody randomly at the other end of the world that you've no idea who it is? Then there's the thing about money laundering. We really need to, as a regulated institution, you really need to demonstrate that you know the origin of funds, where they're coming from, where they're going to, and who the end beneficiaries are. Again, if you've got pseudo-anonymous addresses, you have absolutely no idea who you're dealing with, and you can't really comply with anti-money laundering registration. So how do we embrace regulation? So how do we make that work? How can we adapt a public blockchain to actually make sure that regulated institutions can follow the rules properly? So the first point is to really, like I mentioned, that the rules of every regulator in every country should be the starting point. So there's some degree of overlap between all the countries, like I was mentioning there, the know your clients and anti-money laundering, but there are particular rules in particular countries. And I think it would be madness to try and program all of those on chain and maintain the rules for every single regulator around the world. So if we start out and say, okay, these are the rules that they need to comply with, what can we do on chain to help those regulated institutions comply with the law and the countries that they're governed in? So this is where we can create an on-chain self-sovereign governance structure. So that means that groups can form, manage themselves, and ensure that they comply with the local jurisdiction. So they're organizing. Say we've got a bunch of countries in the European Union who want to trade and use passporting. They can start saying, okay, I'm going to verify that this address belongs to that bank, and that bank can then check the other address belongs to the other bank, and they can start forming a self-sovereign group. They can then set the rules of what can happen within their group, who they can trade with. They can do checks that everyone joining that group is from that jurisdiction, that they're registered there, they live there, if they're retail, and so on. And then this is repeatable across every country. So each one is responsible for making sure they comply to the regulations in their own self-sovereign group. And so you haven't got one single global regulator on chain or anything horrible and centralized like that, but each one can use tools to create their regulatory body, as it were, on chain. So I'd like to introduce you at this point to Tgrade. This is a new blockchain that we're building. It's being built by Confio, the team behind Cosmos, the smart contract engine that some of you, if you're involved in Cosmos, will obviously know about. And what are we going to do with Tgrade? So to secure the chain, we've come up with a proof of engagement platform, or consensus mechanism. So it builds on proof of stake, but we looked at proof of stake and found there were a couple of things that we didn't really like. Firstly, you can have in situations a concentration of power through validators buying up lots and lots of tokens and creating sort of large pools, and that gives them more voting power, and you can get centralization through that. So what we did was looked at it and said, well, how can we improve on this? So the proof of engagement works by recognizing that the community as a whole around the blockchain is involved in running it, should have all the rewards, or the reward should be allocated out to those who are active. So it's not, a blockchain isn't just something that's run by validators. It also has core developers who contribute to the code. It has people that build decentralized apps that deploy to the code. So the chain, you have people active in blogs, people building tools, people helping each other, and all of those lead to engagement points. And those engagement points are then used for the distribution of rewards that comes from transaction fees and commissions from the chain. So we get a fairer distribution of rewards across, which means a more active community around a chain will make it more secure. And then we've also built some other things into into the reward mechanism for validators to disincentivize large accumulation of stake, and that way we believe we can create a very, very active decentralized chain that underpins it. Next up, we're going to create self-sovereign frameworks to facilitate regulatory compliance. So this is the governance framework I was referring to before, about enabling organizations and individuals to create sovereign networks around on the chain that helps them comply with their native regulations. And then we build blocks, or create the building blocks of financial instruments. So we want to make sure that we create components so you can be able to construct new DeFi instruments, either based on existing ones, or you amend them, or you have the freedom to innovate and play. And we bring in financial engineers to help us devise some of these new DeFi things. And then we're going to look at secondary markets. So we've got the issuance, the creations of DeFi instruments, we've got self-sovereign frameworks to allow people to trade those, and then we're going to look at secondary markets of how you continue trading those and create a vibrant financial system. So the big premise is, does regulation kill DeFi innovation? So a lot of criticism is that traditional markets are slow to innovate, there's far too many rules, and DeFi is shown to be really active because they're not constrained by rules. Just because we have self-sovereign groups doesn't exclude any DeFi innovation. So you can have almost like the standard chain outside of these sovereign groups being a sandbox for DeFi innovation. So you can try things out before it gets adopted by regulatory or self-regulated groups. So in no way does it actually stop any DeFi innovation going on. I believe also that the introduction of traditional finance flows will bring in more expertise and allow for much further experimentation. And we'll probably see the development of instruments going beyond the 150% collateralization to create new cash flow models and a real peer-to-peer exchange of value. I also think like one of the big trends in traditional markets is ESG, and there's a lot of confusion about what an ESG product or company or fund really is. So ESG is environmental, social, and governance, which is a big concern for certainly a lot of the younger investors. They really care that the companies they invest in, the funds they buy, have concern for the environment, for social issues, and they're well governed. So here we can imagine developing smart contracts where you would take something like an existing bond. So a bond is an IOU. Say a car manufacturer wants to retool some of their factory to create electric cars. So they borrow 500 million euros for 10 years at 0.875% or something, whatever the prevailing interest rates are. And with a standard smart contract, you could pretty quickly code up that. So the debt issuance could happen on chain quite nicely. We have the full life cycle of paying out the coupons. And at the end of the term of the bond, the redemption activity happens. So then the money's repaid. So where does ESG fit into that? Well, we could actually link some of the outputs of that and the activity of that to the instrument. So what does the production of electric cars mean from an ESG perspective? So let's say that the car manufacturer pledged to sell 150,000 units to a car sharing pool. When it meets those objectives, it publishes it, it gets verified, and it gets called up through an oracle. So what that would do, the smart contract could then say, okay, they've met the objectives. We're now going to issue some social credits, because people by joining car sharing pools means there's less cars owned, the streets are less cluttered, it has a social benefit. So I'm going to create a social credit. From an environmental point, we could say, okay, so we've got a whole load of cars going out there that are electric. So we're definitely meeting some environmental benchmarks here. So let's say for every 10,000 cars they produce, we can start minting environmental tokens or environmental credits. Or we could go back to social and say, well, actually, the electric cars, while they're obviously not zero noise, but they're lots quieter than the internal combustion engine. So if you're living in a city where a lot of people move from internal combustion engines to electric, a lot of the noise, or a lot of the noise from the engines will die down, and you'll still have residual noise from air and braking and the tires and so on, but you'll still be a quality of life aspect, and therefore you'll be able to generate some social credits that way. So you can see there, you can start creating based on traditional instruments where companies have a need to borrow money and they pay interest for that, with some environmental and social aspects put on there. You could also earn some governance tokens or tokens through that, because you're being very transparent about how you're running your business and verifiable outputs. You could then generate governance tokens. So what would these extra elements do? So what would the ESG actually do for somebody wanting to issue a bond on chain and having this type of programmable instrument? So there's quite a few benefits in, given the interest in ESGs type products, there will be quite a lot of demand for the bond issuance, and people will want to have them in their portfolios because they care about these things. So that could have benefits for the issuer, because if there's high demand, they don't have to offer as much interest. So actually it's cheaper to borrow the money in exchange for producing all these benefits. So then you stop looking at pure financial instruments as they are, but you can then see there's benefits for everybody through the life cycle, and it's all possible through smart contracts. So so that's really the background to what's possible in innovation and DeFi. So where are the opportunities in regulated decentralized finance? So I believe that an orderly, regulated DeFi ecosystem facilitates the smooth transfer of assets from traditional markets onto the blockchain, because as we've seen, we can bring innovation. We've covered the regulatory aspects of showing an orderly market and showing transparency, and it'll become a no-brainer to move traditional assets onto, or even create new ones from traditional markets onto the blockchain. And the other one that might be interesting as well to think about is when the regulators put all these laws out, say for money laundering, they want companies and intermediaries to file suspicious activity reports so they can actually look at the information and then figure out if it's real money laundering or if it's a false positive. Imagine if the regulators could actually just plug into an archive node and then read all the data from the blockchain of all the transactions going on. Then they don't need to pester people to say, can you give us that data? Because they have it. They can follow it. They can look for patterns. They can do their detailed analysis and figure out what's going on and where the shady money is coming in, or if it's coming in at all, and maybe provide such a disincentive that the chains become even more robust against dubious sources of money and anti-money laundering. We can see that the tokenization of cash flows will become important. And what I mean by that is in the traditional markets, there's systems of net settlement. So that means I can trade, I can buy and sell all day long happily in my market, and we only settle at the end of the day. Or we can use things like swaps, where I'm going to say a notional amount gets swapped with one interest rate for a notional amount of another one, and we actually exchange the difference as cash flows. These can all be tokenized. They haven't been done yet because the demand for it probably isn't there yet. But as traditional markets look more closely at blockchains, they will look at these instruments and figure out how to do it. Like I mentioned before, we'll see definitely a huge amount of innovation around the programmable instruments, tradable peer-to-peer trading. It's all intermeshed, and we start chipping away at the intermediaries, and we start innovating through how we can do this and the building blocks we make. And I think we'll also see a simplification of investor classifications. So at the moment, there's a very strong distinction in the regulated markets between the wholesale markets and where the retail players come in. So we're starting to see that being chipped away. So for example, the latest pronouncement from the Swiss regulators, FINMA, was that they were looking at digital assets, saying actually wholesale and retail can trade on the same markets. So I think that's a really powerful signal, and I think that's the way it'll go. So we'll have a lot more simple classifications on who can trade with whom. Ultimately, I believe that regulated decentralized finance will actually kill off the need for regulators. We'll need them to begin with because we need to convince people that we have fair and orderly markets. But by building these frameworks, by creating the self-sovereign groups, creating the frameworks for good practice regulation, looking at how we stamp out things like the bad practices of exchanges, making sure that we have frameworks around releasing sensitive information at the same time so everyone can get it. Also being able to say when we're onboarding people, what's the suitability? What do you understand about financial products? What's the right thing for you to invest in? And I think that that can all be done off chain with a governance process around that. But that will mean that we're starting to bring in some of the robustness and looking at the intent of regulations and applying that to a blockchain. So I think that'll become really, really important in establishing that it's not the Wild West. It's not this wildly volatile market that we know and enjoy today, but it will become a lot more not staid or boring, but it will become a lot more fair for everybody to trade, and everyone with who needs protection will be looked after through the mechanisms of governance that we do. And I think it'll be a lot healthier for doing that. So at some point, when the regulators or people that want to track things like, the officials that want to track money laundering, poor behavior, they'll be able to have that information on the blockchain. And the mechanisms around that will demonstrate it's an orderly market, and they don't need to get as involved as they did before. And I think the whole idea of the peer-to-peer trading, the self-governance, will really kill off the need for them to get involved. So to sum up, innovation and regulation is really something that we should be looking at as a market, as we grow the decentralized finance, and as we evolve the products, and bringing in that robust self-sovereign governance layers will ensure that it's not a chain that suddenly supervises everything, but the supervisory or the regulatory frameworks are there for everybody to use and implement how they see fit in the countries that they operate in. And that way we have, like I mentioned, the fair markets, the protection, and we'll also see a huge amount of innovation as people understand what it is that we're building. So yeah, thank you very much for listening, and I'll take some questions now. So okay, so I've got someone commented saying that the government will always try and enforce their power, which is quite an interesting one. I think to be maybe as an interim step, we need to work with them rather than against them. That will bring in, yeah, it'll be difficult to do to begin with, to persuade them that that we need to regulate. But also, I think it's really important that you need to establish that we have a robust system, and the governments at some point will not be able to really get involved too much, because how can they really sort of interfere with it with the blockchain, as long as we've got all the self-sovereign governance there. Yeah, so I sense there's a bit of yeah, opinions, quite a few opinions on about regulation and whether it's a good thing or not. And yeah, I'm really convinced that regulation is a key to this part, and we can't really hide from it, because we sorry, I'm just trying to find the questions properly. Yeah, so I think regulations are there, as I say, as protections for all of us to make sure that we run fair markets, and the states will at some point understand that there's suddenly this system forming there, which is capable of looking after itself and is capable of regulating itself, and there's no need to interfere and step in and get too involved in this, because why would you when everything's working correctly and people are protected and the fair markets are going on? But I'm sure I won't be able to persuade everybody that regulation is good. But I think keep an eye on what we're doing in Tgrade, and you'll see how these self-sovereign systems will evolve, how we get governance around what we're doing, how we manage to reconcile these two. I don't think it's going to be straightforward, but it's going to be a process where we'll learn by doing, and it's a question of really, say, as long as we've got the frameworks right in regulation, then we're going to create the fair systems, and we'll take away some of the need for regulators to really have that surveillance, because it will be so well managed that they won't need to or can't get involved because they become less relevant. So I see that there's a bit of disquiet about from people, comments people are making about the interplay between regulations and power, which is quite an interesting thought. That we've got governments will try and, I'm not sure if they're devious or really wanting to control everything. They can't control things at the moment particularly well, as we see around the world. They have a go, but the regulations aren't
Martin, I'm not sure if you can see the questions at the very bottom, but do you want me to just read it out to you and you can answer them? Because there's five
Yeah,
of them.
that'd be good. Okay,
Cool.
got that. Yeah.
So one of them is by Sunny. He is asking why, for DeFi identity and reputation systems, why should it be on the base layer instead of being on the DApp level?
I think the identity aspect should always be off chain. Where people need to, actually say who they are. I think if you try and do it too much on the chain, you get it gets too complicated. I think having a human and having mechanisms to verify who you are is really something that is best done by people rather than by machines.
Okay. The next question is how much of your governance model has been designed?
So we've got a fair framework of how we want to do it, but we haven't actually written it yet. So again, we've done a lot of thought in how we create this. I read some papers last year on decentralized social organization, which is like looking at how we did DAOs and how we could improve on that with human interaction. So that's really the basis of the governance model of what we're doing. I'd say next year it'll be work in progress as we release more and more. There's a question there on is there a disadvantage to early adopters of regulations? Definitely not, because I think it creates a fair platform for everybody. So I think regulations are really important, and I don't think they'll be disadvantaged. And then one more on how do these regulatory measures affect the user experience in blockchain or the cryptocurrency-based platforms? I think they should be unobtrusive. There's probably an extra step where you need to identify yourself, but I think that as part of the user experience, it shouldn't be that bad. It shouldn't be seen as a hindrance. It certainly shouldn't block you. And then the last question I've got is, it seems regulatory bodies are unable to keep pace of innovation, so how can regulations evolve in a dynamic way? Well, I think the point is that you comply with the standard regulations now, which are off-chain, and create the mechanisms on-chain on how you actually manage that yourselves. But like I say, with time, we'll build stronger rules and governance around what you can do and what you can't do. And that will actually start driving the regulations. So it'll turn around and feed back the other way. So they will be looking at us on the chain to say, look, what are you guys doing? And they will start saying, okay, well, you seem to have got all these things right. We don't need to start interfering. We can start getting rid of some of the regulation, which I think would be really positive.
Awesome. So we are out of time right now. Thank you so much for the really great presentation. We're going to
Thank
transition
you
to
very
the
much.
next session now.